Okay, let's tie beta and CAPM into our corporate finance and talk about the discount rate. You know, we've had cash flows that we've discounted back, and I've always given you the discount rate up until now. And now let's figure out what our own discount rate for an individual company should be. And so when we think about that, we talk about the earlier chapters and where we stand, the appropriate size and the timing of cash flows we talked about, but this section determines the appropriate discount rate when cash flows are risky. So if you think about it, every company is going to have a little bit of different discount rate, and to be able to calculate that, we need to know the riskiness of the company, how much debt they have, what kind of interest rates they're paying on the debt, things like this. So the first thing we're going to talk about here is equity capital and the cost of equity capital. Firms are usually funded by both equity and debt, and let's break out the equity capital first. So every firm has a choice of what to do with its excess cash. It can, one, pay a dividend, and then the shareholder invests it in its own financial asset, and that goes to the shareholder's terminal value. And so the cash dividend can be just handed over to the shareholder. The second option is to invest in a new project. So a company can invest in a new project with the excess cash that's going on, an expansion, if you will, into either a merger or an acquisition, or it could just open a new store. I mean, you open a new Starbucks, open a new Walmart. That would be a project for the company that would build the company and build shareholder value. So here's the question. Because shareholders can reinvest dividends in risky financial assets, the expected return on the capital budgeting project should be at least as great as the expected return on the financial asset of comparable risk. So, in other words, if the company is going to take the excess cash, which is shareholder money, and instead of giving it back to you, we're going to take it and we're going to go invest it in another project. Well, that other project should at least have an expected return that is at least as great as the other projects of that comparable risk. So they shouldn't be just taking out and saying we're just going to keep plowing money into things. They should have at least an expected return of the same level, given the same level of risk that you would have if you had the money in your pocket. So that is what we're trying to get through in the cost of equity capital, is if you don't keep plowing money into projects that are of the same risk or same expected return, given that level of risk, then give me my money back. So an example would be, of course, like, say, PG&E. That's the electric and gas company out here. Well, PG&E's got to have some money for recurring operations. We know that. But they also throw off excess cash. Well, should PG&E start acquiring tech companies? Should they go out and go into the venture capital world? Should they, start buying up pharmaceutical companies or whatever they're doing? Well, of course not. That's not their business. That's not what they know. So when they throw excess cash, what do? They pay it out in dividends. And they pay it out in dividends to people so they can take that money and go invest it in something better. But the return on the company is going to be relative to that company's level of risk and reward, and a gas and oil company is probably going to be a fairly low beta return because there's not much volatility in their earnings because the electric company is pretty much a monopoly. So when you start thinking about it in terms of the cost of equity capital, there's no other thing they could do that's very similar to what they do now that they have expertise in. So what they should do is take the money and give it back in dividends. Now take another company that's growing quite quickly. If you took, say, Home Depot or Walmart or one of these big franchise, or not franchise, but one of these big stores, they open five stores. Well, they shouldn't give you your money back. What they should do is give you excess cash. So they should do with that excess cash is build the next store. That makes sense. So when you think of excess cash, the question is, can you continue to reinvest it at the risk and return that you're at now? Or if not, if you've matured in your company and you're just throwing off excess cash because you've grown as big as you can grow, well, then throw it back in dividends. Even Apple now is paying a dividend because it's grown so big and it has so much excess cash. It has to return it back to shareholders, even though they're starting a car company and all these other things. the idea of having excess cash, they've got hundreds of billions of dollars in the bank. They could throw a dividend off because they don't need it all. So that's the question of excess cash. If you can continue to grow the way you're growing with regard to risk and reward, that's fine. If not, throw it off as a dividend. So the question is, what is the number? What is that growth number? What is the hurdle rate of what a project should be for the cost of equity capital? And we're going to get into that next.